You know what's fascinating? While everyone's watching their stock portfolios bounce around like ping pong balls, there's a completely different game being played behind the scenes. And if you have any physical wealth right now, any real assets, you're sitting on something that's about to become incredibly valuable. Let me show you what I mean. Right now, gold is trading above $3,400 an ounce. Silver's hovering around $32. And here's what nobody's talking about. These aren't just numbers on a screen anymore. Something fundamental has shifted in how the world views physical assets, and the implications are staggering. Let me paint you a picture of what's actually happening. Central banks just bought 220 tons of gold in a single quarter. That's a 28% increase from the previous quarter. Think about that for a second. These are the institutions that print money, that control monetary policy, that have access to every financial instrument imaginable. And they're buying physical gold at the fastest pace we've seen in modern history. But here's where it gets really interesting. They're not buying gold ETFs. They're not buying gold futures. They're demanding physical delivery, bars in vaults, metal you can touch. And they've done this for 3 consecutive years, purchasing over 1,000 tons annually. That's not a trend. That's a complete restructuring of how sovereign nations view wealth. Now, why does this matter to you? Because when the people who create money start hoarding the thing that's been money for 5,000 years, they're telling you something. They're not buying it because they think it'll go up 10%. They're buying it because they know something about the system that most people don't understand yet. Let me take you back to a moment in history that rhymes with today. 1971. Nixon closes the gold window. The dollar becomes pure fiat currency, backed by nothing but faith in the U.S. government. And you know what happened? Gold went from $35 an ounce to $850 by 1980. That's a 2,400% increase in less than a decade. But here's what most people miss about that story. It wasn't just about the price going up. It was about a fundamental shift in how wealth was measured. People who held physical assets, real things, they didn't just make money. They preserved their purchasing power while everyone else watched their savings evaporate through inflation. Fast forward to today. We're seeing something eerily similar, but on a much larger scale. The difference? This time it's not just the United States making monetary decisions that affect the world. It's a multipolar shift. Countries are actively working to reduce their dependence on the dollar. They're settling trade in their own currencies. They're building alternative payment systems, and they're backing it all with physical gold. Think about what that means. For decades, the dollar has been the world's reserve currency because everyone needed it to buy oil, to settle international trade, to store their reserves. But what happens when that changes? What happens when countries can bypass the dollar entirely? Here's a specific example that should make your hair stand on end. China and Saudi Arabia are now settling oil trades in yuan. Russia and India are trading in rupees and rubles. Brazil is pushing for a BRICS currency. These aren't small players. These are massive economies representing billions of people, and they're systematically building infrastructure that doesn't need dollars. And every single one of them is accumulating gold, not as an investment, as insurance, as a foundation for whatever comes next. Now let's talk about silver for a moment, because this is where the story gets even more compelling. Silver has this unique characteristic where it's both a monetary metal and an industrial metal. And right now, we're seeing something that's never happened before in history. We're in a structural supply deficit. What does that mean in plain English? The world is using more silver than it's producing, every single year. And it's not because of jewelry or coins. It's because of solar panels, electric vehicles, 5G infrastructure, medical devices, all the technology that's supposed to save us from climate change and power the future. It runs on silver. Here's a number that should shock you. Each electric vehicle uses between 25 to 50 grams of silver. Doesn't sound like much, right? But we're talking about millions of vehicles being produced annually. A single solar panel uses about 20 grams, and we're installing solar capacity at record rates globally. The solar industry alone is projected to consume over 200 million ounces of silver annually. That's roughly 20% of total global supply, and that demand is accelerating, not slowing down. But here's the kicker. Unlike gold, which mostly just sits in vaults and gets recycled, silver gets consumed. It gets used up in industrial applications where it's not economically viable to recover it. Once it's in that solar panel or that circuit board, it's essentially gone from the supply chain. So you've got increasing industrial demand, you've got investment demand from people waking up to inflation, and you've got a supply that's been in deficit. What do you think happens to the price? Now, I want to address something that might be on your mind. You might be thinking, okay, but I've heard this story before. Gold and silver are always supposed to go up, and sometimes they just sit there for years doing nothing, and you're right to be skeptical. But here's what's different this time. It's not just about inflation. It's not just about fear. It's about the actual structure of the global financial system changing in real time. Let me give you a concrete example. The COMEX, which is the major exchange where gold and silver futures are traded, has been experiencing something unusual. The amount of physical metal available for delivery has been shrinking while the number of paper contracts has been growing. Think about what that means. You've got more and more people holding contracts that say they own gold or silver, but there's less and less actual metal to back those contracts. It's like a game of musical chairs, and the music is about to stop. And when people start demanding physical delivery, when they stop trusting the paper promises and want the real thing, that's when you get what's called a squeeze. Prices don't just go up gradually. They spike. They gap up overnight because there's simply not enough physical metal to satisfy all the claims on it. We've already seen hints of this. There have been moments where premiums on physical silver coins and bars have spiked to $4, $5, even $6 over the spot price. That's not normal. That's a sign of stress in the system. That's a sign that people are willing to pay significantly more to hold the actual metal rather than a paper promise. Now, here's where this gets personal. If you're someone who's worked your whole life, who's saved money, who's built up some wealth, you need to understand what's at stake. The wealth you've accumulated, if it's sitting in dollars, in bonds, in traditional financial instruments, it's essentially a claim on a system that's being fundamentally restructured. I'm not saying the system is going to collapse tomorrow. I'm saying the rules are changing. And in every period of history where the rules changed, where monetary systems were restructured, the people who held physical assets came out ahead, not because they were smarter, because they understood that real things have value regardless of what happens to paper currencies. Let me tell you about something that happened in 2008. When Lehman Brothers collapsed, when the financial system was teetering on the edge, you know what happened to gold? It went from around $700 an ounce to over $1,900 by 2011. But here's what's fascinating. It wasn't just the price, it was the behavior. People who had never thought about gold before were suddenly trying to buy it. Dealers were running out of inventory. Premiums were through the roof. Because when the system shows cracks, people instinctively reach for things that have held value for thousands of years. And we're seeing those same cracks now, but bigger, more fundamental. This isn't just about one bank failing or one country having problems. This is about the entire architecture of global finance being questioned. Quick aside here, because this is relevant. If you're sitting on $100,000 or more in retirement accounts, traditional IRAs, 401ks, you might want to look into how gold IRAs work. I put together a free guide that covers how you can get physical gold into your retirement account without triggering tax penalties. It's in the description. Worth checking out if you're thinking about protecting a portion of your retirement savings with physical assets. Anyway, back to what's happening in the markets right now. Because there's another layer to this story that most people completely miss. The relationship between gold and silver, what's called the gold to silver ratio, is telling us something important. Historically, this ratio has averaged around 60 to 1. Meaning it takes 60 ounces of silver to buy 1 ounce of gold. Right now, we're seeing that ratio compressed, but there have been times when it's spiked to 80 or even 100 to 1. And here's what history shows us. When that ratio gets stretched, when silver becomes extremely cheap relative to gold, it doesn't stay there. It snaps back. And when it snaps back, silver doesn't just catch up to gold, it outperforms it dramatically. In 2010 and 11, silver went from around $17 to nearly $50 in less than a year. That's almost a 300% move. Gold went up during that same period, but nothing like silver, because silver is the leveraged play on monetary metals. It's more volatile, more explosive, and when it moves fast. Now, I want you to think about the current environment. You've got governments around the world running massive deficits. You've got central banks that have printed more money in the last few years than in the previous century combined. You've got inflation that's officially reported at one number, but feels much higher when you're buying groceries or paying rent. And you've got a generation of people who've never experienced real inflation, who've never seen what happens when currency loses purchasing power rapidly. They're about to get an education. Here's a thought experiment. Imagine you're holding $100,000 in cash. Now imagine that over the next 5 years, that $100,000 buys you what $70,000 buys you today. You haven't lost money in nominal terms. Your bank account still says $100,000, but your purchasing power has been destroyed. Now imagine instead you had taken a portion of that, say 20 or 30%, and converted it to physical gold and silver. Even if those metals just kept pace with inflation, you've preserved that purchasing power. But if they do what they've done in every previous period of monetary instability, you've not just preserved wealth, you've grown it significantly. This is what wealthy families have understood for generations. This is why old money, real generational wealth, always has a significant allocation to physical assets. Not because they're trying to get rich quick, because they're trying to stay rich over long periods of time, through multiple economic cycles, through currency crises, through system changes. Let me share something that might surprise you. There are families in Europe, old aristocratic families, who still hold gold that their ancestors bought hundreds of years ago. Think about that. Through world wars, through currency collapses, through revolutions, that gold maintained its value. The currencies changed, the governments changed, the economic systems changed, but the gold remained valuable. That's not a coincidence. That's the fundamental nature of physical assets. They exist outside the system. They don't depend on any government's promise. They don't require any institution to honor a contract. They simply are. And right now we're in a moment where more and more people are starting to understand this. Not just wealthy families, not just central banks. Regular people who are watching their savings lose purchasing power, who are seeing prices rise faster than their incomes, who are feeling less secure about the future. This is creating demand from a completely new segment of the market. People who never thought about gold and silver before are now buying. And they're not buying to trade. They're buying to hold. They're buying because they want something real, something tangible, something that doesn't depend on the financial system functioning perfectly. Now, let's talk about what happens next, because understanding the past is important, but you need to know where this is heading. The trajectory we're on, with central banks buying at record pace, with industrial demand for silver accelerating, with more countries moving away from dollar dependence, it points to one outcome: higher prices, significantly higher prices. But it's not just about the price going up, it's about what that price represents. When gold hits $5,000 an ounce, when silver hits $50 or $60, that's not just metals getting more expensive. That's the market repricing the value of physical assets relative to paper currencies. And here's what most people don't realize until it's too late. By the time everyone understands what's happening, by the time it's obvious that you should own physical metals, the opportunity has largely passed. Not because you can't still buy them, but because the price has already adjusted to reflect the new reality. Think about real estate in major cities. 20 years ago, you could buy property in places like San Francisco or New York for a fraction of what it costs today. People who bought then weren't geniuses. They just understood that physical assets in desirable locations would hold value. The people who waited, who said, "I'll buy when I'm sure," they missed the opportunity. The same principle applies here. The time to position yourself in physical assets is before everyone else figures it out, before the mainstream media is running stories about gold shortages, before your neighbors are talking about buying silver, before the price has already made its major move. And we're still in that window. Yes, gold is at all-time highs. Yes, silver has moved up significantly. But relative to where this is going, relative to the amount of currency that's been created, relative to the structural changes happening in the global financial system, we're still early. Let me give you some perspective. The total value of all the gold ever mined is around $15 trillion at current prices. Sounds like a lot, right? But compare that to global debt, which is over $300 trillion. Compare it to the derivatives market, which is estimated at over $1 quadrillion in notional value. Gold represents a tiny fraction of global financial assets, and silver is even smaller. So when people start moving even a small percentage of their wealth into physical metals, the impact on price is enormous. Because the market is relatively small and the supply is limited, this is why you see such explosive moves in precious metals during periods of uncertainty. It doesn't take much capital flowing in to move the price significantly. And once that move starts, it tends to feed on itself. Higher prices attract more attention, which brings more buyers, which pushes prices higher. We saw this in the 70s. We saw it in the 2000s. And we're seeing the early stages of it now. The question is, are you going to be positioned before the main move, or are you going to be one of the people trying to buy after everyone else has already figured it out? Now, I want to address something important. This isn't about fear. This isn't about predicting doom and gloom. This is about understanding cycles, understanding history, and understanding that the financial system goes through periods of change. We're in one of those periods now. And during these periods, the people who do well are the ones who adapt, who understand what's happening, who position themselves accordingly. They're not panicking. They're not hoarding canned goods in a bunker. They're simply allocating a portion of their wealth to assets that have proven themselves over thousands of years. Think of it like insurance. You don't buy fire insurance because you're certain your house will burn down. You buy it because if it does, you want to be protected. Physical gold and silver are insurance against monetary instability, against currency debasement, against system changes that could impact your wealth. But here's the beautiful thing about this insurance. Unlike regular insurance, which costs you money every year and hopefully you never need to use, physical metals have the potential to not just protect your wealth, but grow it significantly. You're getting protection and opportunity in the same asset. Let me share one more historical parallel that I think is crucial to understand. In the 1920s, Germany experienced hyperinflation. The currency became worthless. People were using wheelbarrows full of cash to buy bread. Life savings were wiped out overnight. But you know who survived that period? People who owned physical assets, real estate, gold, silver, even things like art and antiques. Because while the currency collapsed, these things maintained their value. A gold coin could still buy what a gold coin had always bought. The number of marks it took to buy that gold coin changed dramatically, but the purchasing power of the gold itself remained stable. Now, I'm not saying we're heading for hyperinflation, but I am saying that the principles remain the same. Physical assets maintain value when currencies don't. And right now, with the amount of currency creation we've seen, with the debt levels we're carrying, with the structural changes happening in the global financial system, having a portion of your wealth in physical assets isn't radical. It's prudent. Here's what I want you to take away from this. If you have physical wealth right now, if you have savings, if you have assets, you're in a position to make a decision that could define your financial future. You can keep everything in the traditional system, in dollars and bonds and stocks, and hope that system continues to function as it has. Or you can diversify a portion into physical assets that have proven themselves through every economic cycle in human history. This isn't about going all in. This isn't about selling everything and buying gold and silver. This is about balance. This is about having a portion of your wealth in assets that don't depend on the system, that exist outside of it, that will maintain value regardless of what happens to currencies or governments or financial institutions. The wealthy understand this. Central banks understand this. And increasingly, regular people are starting to understand this. The question is, will you understand it in time to position yourself, or will you understand it after the opportunity has passed? Because here's the thing about these moments in history. They don't last forever. There's a window where you can act, where you can position yourself, where you can make decisions that will benefit you for years or even decades to come, and then that window closes. Not because you can't still buy gold and silver, but because the price has already adjusted to reflect the new reality. We're in that window right now. Gold above $3,400, silver around $32, central banks buying at record pace, industrial demand accelerating, countries building alternatives to the dollar system. All the pieces are in place for a significant repricing of physical assets. The only question is, what are you going to do about it? Are you going to wait and see what happens? Are you going to hope that everything stays the same? Or are you going to take action, allocate a portion of your wealth to physical assets, and position yourself for whatever comes next? This is your moment. This is the time when decisions matter. This is when you look back years from now and either say, I'm glad I acted when I did, or I wish I had understood what was happening. The information is in front of you. The opportunity is available. The only thing left is the decision. And that decision ultimately is yours to make. But make it with full awareness of what's happening in the world, of how the system is changing, of what history teaches us about periods like this. Because if you have physical wealth right now, you're sitting on something valuable. The question is, are you going to preserve it, protect it, and potentially grow it by diversifying into assets that have stood the test of time? Or are you going to leave it all in a system that's being fundamentally restructured as we speak? The choice is yours, but the window won't stay open forever.